What are the latest trends in terms of local currency Asian debt investments following the global crisis?
Yeah, we've seen a general interest in the emerging market products, but specifically also now for Asia-only debt products. There's a couple of things that would be underpinning this. Clearly, there's a lot more focus on macro and specifically fiscal fundamentals, and Asia tends to compare pretty well, not only in comparison with G3 markets, but also within emerging markets. I think at this point, investors differentiate much more between the weaker and the stronger players in the emerging market space, and Asia tends to compare pretty well to the likes of, for example, Central Europe. At the same time, the trends that we witness in Asia itself is that interest from institutional investors in the region has picked up significantly. And there's a range of investors that you could think of, central banks, sovereign wealth funds, pension funds, and the occasional insurance company. And I think the interest right now, and it's actually not only Asia but also from outside of Asia, is pretty broad-based. I mentioned central banks as the first. I think in many ways they have been pretty critical in garnering interest in the asset class by launching a number of initiatives, but also importantly by investing some of their money into these debt markets. And the trend that we've seen is enabled by the enormous FX reserve accumulation over the past 5 years. Reserves doubling, tripling. There's much more reserves available right now than is strictly necessary from a precautionary standpoint. And so whether you look at coverage in terms of external liabilities or imports, or well above levels that you would normally need to have. So that leads to a lot more flexibility in terms of what central banks can do with these reserves. And at the margin, you definitely see them dabbling into Asian government debt markets. And this is obviously also enhanced by the relatively poorer developments, the fiscal issues that we've seen appearing in the core, in the G3 debt markets. So interest has generally started with Southeast Asian central banks. We slowly see it moving to some of the Northeast Asian central banks as well. They tend to focus a little bit more on the more liquid, larger debt market as well. In Southeast Asia, the interest seems to be a little bit broader across all regional debt markets. Now, for pension funds, the general observation would be, and this is not only Asia, that most pension funds would generally approach emerging markets as you want to access that through equity, capture the upsides. So typically they've been underexposed to emerging market debts. Typically the debt investments are traditionally in very safe markets, or what was seen as safe markets. But I think the one lesson over the last 5 years, if not longer, is whether you look at risk-adjusted returns or even absolute returns, that emerging market debt is probably an asset class that shouldn't have been overlooked, and slowly but steadily we see inflows coming in from that direction as well. Now lastly, insurance companies, which would also be a natural buyer base for specifically long maturity bonds. We also see reallocations from other debt classes, for example developed market debt, into Asian bond markets. And like I said, this interest is broader than just from Asia alone. We've seen that coming from the likes of Japan and the likes of Europe.
What are the risks of investing in local currency Asian debt?
Well, now we're talking about mainly government bonds. Clearly, if you look at the macro numbers underpinning Asia government bonds, then we're not that concerned. So trends tend to be relatively positive. We haven't really seen any downgrades over the last couple of years. It's largely been credit upgrades, and that reflects relatively healthy balance sheet conditions that we witness in Asia. Modest budget deficits, stable to slightly improving leverage ratios for the sovereigns themselves. So from that perspective, we see little reason to be concerned. The concerns that we would have is that, like many other asset classes, if too much money ends up in a specific asset classes, then, and in particular for relatively smaller, less developed bond markets that we have in some countries, then it's more the technical aspect of that would lead to some concerns. And then we're talking about the percentage of foreign ownership and the possibility that this money could leave these markets again in a relatively short time span if the cycle turns. Having said that, we do think that there are, at least to some extent, some structural changes in that level as well. Previously, a couple of years ago, the flows into emerging markets and definitely also into Asia would be much more opportunistic. If anything has changed over the last couple of years, is that allocations, and now we're talking about the flows that we've seen from some of these institutional investors, is that some of these allocations are a lot more strategic. They're benchmarked against specific bond indices. Hence, the allocations that we see in some of these markets, even if these ownership levels are relatively high now, are probably a bit more stable than what was used to be the case in the past. A good case is Indonesia, where we've gone through a couple of road bumps in the last year. Europe, fears of a double dip. We haven't seen any outflows of that bond market as of yet. So that should bode well for the future.
What are the latest trends for the renminbi bond market?
Okay, I think the developments that you're referring to is the development of the offshore bond market, which is very much focused on the availability of renminbi in particular in Hong Kong. So clearly activity has picked up. The measures that have been put in place by China have in general come quicker than most of us expected. It's definitely focused on putting infrastructure in place for increased use of the renminbi and trade transactions, and coming with that, you need to have avenues where this renminbi liquidity is going to end up. So in that respect, the issuance offshore in Hong Kong has definitely accelerated. We've seen bonds not only from Chinese issuers, but the bonds from, for example, a US corporate issuer. There is a healthy pipeline of more similar bonds to come to Hong Kong. Generally, the idea still is that it's probably not enough to absorb all the liquidity that there is. The pool has grown pretty quickly. We're above 100 billion right now. And if Chinese regulations don't change, it's easy for that number to grow to double, triple, and even quadruple in the next couple of years. At the same time, so there's one development is the offshore bond market. The second development is increased access to the onshore market. That's through the regular QFII channel, but also the mini QFII getting increased access for at least a number of players into the domestic bond market.